Hello everyone, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this Analyze Out Loud video, I'm going to look at my two favorite utilities, NextEra Energy Inc., which is previously known as Florida Power and Light, which they still have that division, and WEC Energy Group, which also used to be known as Wisconsin Energy Corp. Now, as you look at these two graphs, what I really want to point out is why I really like them, first of all, because I think these are two of the best run, best utilities in the country. You'll notice Wisconsin Energy, or WEC Energy Group, has consistently grown earnings at over 7.1%. The company offers a current dividend yield of 3.2%. It's A- rated and only has 42% debt to capital. Next, I want to look at dividends and the dividend payout ratio. You can see that their dividend record has been very consistent. There are times when it was flat during 2002 and 2003, but otherwise they've grown their dividend at a very nice rate, and you can see they're paying out a very large portion. Their payout ratio has actually increased over time. It was a lower payout ratio back here in 02 to 09, and it's higher now. So let's go ahead and look at dividends and dividend payout ratio real quick. So you can see their dividend was flat for 02 and 03, but then they've increased it quite nicely. And there are times when they've increased the dividend by rates of over 20%, as you can see. So their average dividend growth rate's been 11.3%, and their compound average growth has been 10.9% since December of 2002. And notice this is a quarter here, it's not a full year. But you can see their payout ratio has gone from the mid 30% range, 34, 36%, up into the 40% range, up into the 50%, and now into the 65 to 70% range. And you can see that increase. This area below the white line is the dividend payout ratio. Similarly, if I look at NextEra Energy from the same perspective, their earnings growth has been 7.3%. They're A- rated, have 48% debt to capital, slightly lower dividend yield at 2.6%. But we see a much more consistent dividend payout ratio. It was in the high 40s and 50% range, and it's kind of stayed there. So when you look at NextEra Energy, you can see that their dividend payout ratio has been very consistent over this period of time. Now, these are all things that I really admire and like about a company. Very consistent earnings growth year after year for both companies, a good dividend record with good dividend growth year after year. NextEra Energy has slightly more growth, but slightly less yield. WEC Energy Group has slightly lower growth, but a little more current yield, again, because they're paying out more of their dividends. So now I'm going to finish the graph. I'm going to add the dividends after they've been paid out. This is simply this portion of the graph, which was the earnings when they belonged to the company. And this light green shaded area just shows the dividends after they belong to you, the shareholder. So you can see the dividend payout ratio. Now I'm going to add monthly closing stock prices, because the point that I'm going to make in the write-up on this article is that I love the company, and I've tried to articulate that here. There's everything about this company is great, and I also feel the same way about NEE or NextEra Energy. What I don't like is the current valuation. So when I put monthly closing stock price on the graph, this orange line is a normal valuation of a PE of 15. And I want you to notice from 2002 all the way through the Great Recession into 2010 and 2011, a 15 PE ratio was where this company traded at, more or less. You know, got a little below it at times, got a little above it at times, but that was clearly a solid fair valuation reference. You can see that the price tracked that. Then starting in January of 2012, we started to see a separation, and now the valuation has gotten higher and higher. I do want you to see this constant, up and down movement that's going on in the stock price here, where it keeps coming back to the reversion to the mean. The current blended PE ratio is 21.2, and it's significantly higher than it's historically been. So this is one valuation measurement that I want you to see when you're looking at Wisconsin Energy. Now, likewise, when I go to NextEra Energy, you're going to see a very similar situation here. A normal PE ratio, or a fair value PE ratio of 15. That was a very relevant valuation index, or reference, if you will, for this company. Then we see this separation, and now we've got this high valuation with the PE ratio of 23. Now, I'm going to add that PE ratio to the graph in this case for NextEra Energy. This is the highest PE ratio that the company's traded at in this time frame. Even back here when it got overvalued just prior to the Great Recession and coming into the Great Recession, it still didn't trade at this high valuation. I want the viewer to understand that this is an extremely high valuation for this particular company. Now I'm going to do the same thing with Wisconsin Energy. I'm going to take their current PE ratio, their blended PE ratio, which is 21.2, and I'm going to go ahead and add it to the graph so that you get that same perspective. Because what I'm pointing out here is that I love both of these companies. I think they're great. There's lots of articles talk about really good stories about how good these companies are and how they're moving into all types of additional businesses, and all of it is true. The only thing I don't like is the current valuation. You can see this 21.2 is an excessively high valuation. It briefly hit it in 2015 before dropping precipitously. It kind of exceeded it a little bit in 2016 before dropping, and so on. And the point is, these valuation levels are excessively high. Now, here's where it really gets interesting, and I really want you to focus on what I'm about to say. Nothing has really changed about these companies. So I'm going to get rid of the pink line. I'm going to get rid of the price also, because I don't want that to contaminate the look. And I'm going to go ahead and get rid of the dividends again. I just want you to look at earnings and earnings growth. So now we've got earnings growth going back to 2002, averaging 7.1%. I'm going to chop some years off here. I'm going to go back to 2007. We see 7.9% growth. I'm going to drop it to a 10-year. Now we're below that long-term growth, 6.9. I'm going to drop it down since 2015, and we're at 5.9. What I'm getting across here is the earnings growth rate of this company, and I'll look at NextEra Energy next, has actually slowed down relative to its long-term growth rate, and yet its valuation is higher than it's ever been. So let's do that same exercise with NextEra Energy. Let's go ahead and start out with the long-term graph. We see 7.2% growth. I'm going to drop it down to a 15 graph. We see 8.6. This was a good period. I go to the 10-year graph. We're now down to 7.6. I go to the 6-year graph. We're back up to 9.1. So the point is, nothing is really materially changing. Growth is a little better in recent years than it has been, and you can see that here at the bottom of the graph. You have one really good year that's raised the average. Otherwise, I want you to notice 7 to 8% is the growth rate for the company. When I look at Wisconsin Energy, I want you to also see you've got 5.9, but you've got a 9% year in there, and you also have a 3% year. You've got 6 and 7% growth rates. So let's go and look at forecasting and analyst estimates. Now, one thing about both of these companies, or at least I'll start with Wisconsin Energy, I want you to notice their analyst scorecard on earnings has been excellent over the last 5 years. The analysts have got it right every year, and they've also got the 2-year forward forecast right. So the company gives good guidance, and the analysts have been getting it right. So the estimated future growth is 6%, which is consistent with what I showed you on Wisconsin Energy's long-term norm. The problem is that is trading at these very excessive valuations. So if we would get a reversion to the mean over the next year or so, you could actually lose 16% of your money. If you go all the way out to year-end 2021, you would still have a negative rate of return by investing in WEC Energy or Wisconsin Energy Group. Let's take a look at that from the same perspective with NextEra Energy. Let's look at what the company's earnings forecasts are. Now here we've got a higher forecast, which is 9.9%. But once again, we've got a much higher PE valuation. I want you to notice. Again, I love both of these companies. But if this were to revert back to a 15 PE ratio, which would be quite common for a company with that growth, you'd have a 27% capital loss, and add in some dividends, and it's an annualized loss of 18.3%. And out to 2021, it would be a minus 1.3%, a total loss of 14.9. That's a simple what-if calculation if it went back to that PE. In contrast, if it stayed at its current PE of 21.3, you could make 11% by investing in NextEra Energy. And similarly, if you went and used that same concept with Wisconsin Energy and looked at it trading at its current PE of 21.2, I've got 21 here, it's close enough, you could make 8.77%. But that simply means you expect the company to continue to trade at a PE ratio that's high relative to its historical norms. And you can see that very clearly when you apply the whole graph here and look at everything. This is a real high valuation. Let's look at some other valuation references. Let's look at interest rates real quick. Now, I want you to notice as interest rates were dropping, the PE ratio of this company this is WEC Energy, was rising. That's the blue line. The burgundy line is the interest rates. But as rates are expected to start rising again, that could be a downside. But you can see that the PE ratio is still much higher than any historical norm on the graph here. Another valuation reference is price to sales. Historically, this company's traded at about 1 to 1.5 to 1.2 times sales. It's currently trading at 2.8 times sales. That's a significantly high valuation level. Apply that same type of information to NextEra Energy, and you see as interest rates were dropping here, the PE ratio got high. But again, I go to price to sales. We see a normal price to sales about 1.23, 1.25. Today, we're looking at price to sales of 4.7. So no matter what kind of valuation reference, let's look at both of these companies from a standpoint of price to EBITDA over the long run. You can see a normal price to EBITDA of about 5.3. NextEra Energy is currently trading at 8.9. My point is you've got very high valuation. You've got great companies, and there's a lot of great stories. Wisconsin Energy, WEC, a price to EBITDA of 5.5, trading at a price to EBITDA of 8.7. The whole point of this exercise is to illustrate that you've got excessive valuation. And I want you to notice, had you bought the stock when it was trading at a very high price to EBITDA here of 6, I'll even find one as close as I can. I'll go back here to June of 2012. That's 7. That's less than what it's currently trading at. But if you still held it today, you'd have made 12%. Likewise, let's do a similar exercise with NextEra Energy. It's currently trading at a price to EBITDA of 9. Here's a price to EBITDA of 7. Over the last couple of years, you make 19% a year. The point is, when stocks have momentum on their side, like these stocks have here, you can see that they've been technically, by my definitions that I've been articulating, overvalued for years. Both of these companies have had excessive overvaluation during this bull market. By the way, the stock market is overvalued like this as well. But longer term, these valuations don't make sense, because one of the things that I want to point out, I'm going to go back to earnings here and just show you another graph. You look at Wisconsin Energy right now. Earnings yield for this company is, for next year now, is under 5%. If I go to NextEra Energy and look at the earnings yield of it for next year, it's under 5%. And 6.5 to 7 would be normal. So my point is, these are great companies. They're significantly overvalued relative to fundamental valuation references. Any way you want to measure it, they're overvalued relative to their potential for future growth. Great companies, they're just overvalued. The point is, I want the viewer to be aware that these valuations exist. I'm not saying sell them. They've got plenty of momentum. They're continuing to do well. So let's, go ahead and look at even what they're doing today. NextEra Energy is up a little bit today. If I look at WEC, we're also seeing that it's up a little bit. So these stocks continue to have momentum. The real problem is valuation is excessively high, and it's been high for several years. And that's kind of, to me, a time bomb, because as you saw periods of overvaluation before, you could end up with very poor long-term returns if you bought the stocks here. If you've held them for many, many years, as many people have, you might be willing to walk through that, because your long-term rate of return, for example, if you bought it back here when it was fairly valued, this is NextEra Energy at a PE of 13, and it did revert to that PE, you'd still make 9.5% per annum. However, if you look at it from another perspective, and I'll try to hit the same time frame again, kind of missing it, but there I had it. If I look at the same time frame again and look at it from here, I'm averaging 11%. So you'd give up a little bit of return, but you'd still have an average rate of return that's high if it reverted to the mean. But if you're buying here where the stock is trading at these high valuations and it reverts to the mean, then you could have very weak rates of return and actual negative rates of return based on growth. Anyway, I hope you've enjoyed this video and gave you some perspective on the relative valuation of my two favorite utilities, NextEra Energy and Wisconsin Energy. Thanks for watching.